Thanks, Brianna. Folks, thank you so much for joining today so we can talk about manufacturing and R&D and how it is used for manufacturers. I wanted to give you a high level of why we are credentialed to speak about the R&D tax credit today. We are one of the largest service providers for tax credits in the country. We do $1.1 billion a year for our clients. We have more than 5,000 clients nationally. We've been around for about 30 years because if you think about it, a lot of these programs are heavily dependent, including research and development, on payroll. So it's how we got started years ago. What our R&D practice and what's unique about it is that we use engineers and software developers to help qualify and speak to companies and really dig in and speak your language and find out what's happening in your businesses that may qualify for a tax credit. So we're going to jump into the federal and state research and development tax credit and how it pertains to manufacturing. I first want to start with a couple stories. So here's a couple companies that we've worked with in the last couple months that had no idea that they qualified for R&D, and it's how we're getting out there and telling companies that there's activities out there for them that qualify for this federal and state benefit. And most of them are unaware that they qualified prior to that conversation. The first one is a trucking company in Dayton, Ohio. And so they make custom trucks, everything from snow plows to police cars, ice trucks. And so when they come in and they're just from the chassis up customizing these trucks, and every truck is unique, they don't really standardize the process, it's just per order. You can consider each one of those builds a prototype. We really dove into their intellectual property, who owns the rights and risks to those trucks, who owns the engineering pieces of that. And what we did, we decided and came to the conclusion is they own all of that intellectual property. So they own what is the prototypes and the research and development. So the company now can claim $200,000 a year for the salaries and supplies that put into that. They can also go retroactive 3 years. So we're almost looking at $800,000 for this business in Ohio that had no idea that they qualified for R&D. Another example is a shoe manufacturer that we spoke to in Columbus. They are in the wrestling, sport of wrestling. They make shoes. When we were talking to them, I spoke to the owner. He had all kinds of prototype shoes. And what's fascinating about it is that each prototype has different raw materials. They're based around functionality, not just aesthetic, like changing colors. So each one of those prototypes and all of the construction that goes into building those shoes can be considered for, an R&D credit. The result of that and all the supplies and salaries used in that raw material came to about $50,000. They also had the opportunity to go retroactive. So it's sometimes just worth a conversation if you're in the manufacturing industry to find out if you qualify for an R&D credit. And so this slide, we just wanted to show the differences in the federal credits, the large federal credits out there. Solar credits are exploding, but it's pretty, the allotment of dollar amount is pretty much the same year over year. For Work Opportunity Tax Credit Program, also a very large federal incentive, also pretty federal. This is in terms of billions of dollars allotted. If you look at the research and development credit, and Sanjeev is going to go into all the changes that have taken place around this, but there is a climb in incentives that's going to be allocated to research and development. The credit has become permanent, and it's just going to be a year over year increase. Our statistics show that half of this is left on the table each year. So manufacturers out there are missing part of that billions of dollars that leaves sitting on the table. So that's what we're going to get into a little bit more today. Start talking about activities and see if there's a potential for you.
All right, thank you, Diane. And so what I'll do is I'll talk a bit about the R&D tax credit. I'll go through and do a deep dive on it, and we'll talk about the different types of activities that qualify, talk about the industries that claim the credit, we'll talk about some of the costs that qualify, and some other nuances with the credit. But the federal R&D credit was designed as a credit for increasing research activities, and it was established in 1981 and made permanent as part of the PATH Act in 2015. Between those 2 years, the credit actually expired and was extended over 15 different times. We're very happy that it became permanent, most notably because now taxpayers can actually plan to use the credit in future years. The credit itself was designed to encourage the performance of technological science here within the U.S., and that is the principles of engineering, physics, chemistry, or the life biological or computer sciences. Therefore, any cost that we associate with the credit or allocate towards the credit has to be associated with work performed here within the United States. The credit itself, actually being enacted in 1981, was designed to initially help manufacturers and incentivize manufacturers to perform R&D here within the U.S. The credit itself works as any general business credit in terms of its use to offset regular tax liability up to a limitation known as a 38C limitation. And so you're actually able to use the credit to offset tax that you've paid up to that limitation, and any unused credits actually carry forward up to 20 years. So it's not a use or lose credit. Now, there are some exceptions, starting with the PATH Act, which was enacted in 2015 and came into effect in 2016, that we'll talk about here in a little bit later. For certain businesses, they can offset more than just their regular tax. The credit itself can be claimed retroactively. Diane just mentioned we can go back 3 years retro, so you can actually go back to an open return. Typically, that's 3 years, and amend a return with the R&D credit. The R&D credit goes on the Form 6765. It's filed or amended on the return, and then you, the taxpayer, will get a check back from the government for any overpaid tax or any paid tax that you can use the credit to offset. For the current year, you would actually file the credit on the return, and you would be able to offset tax instead of having to pay it at that time. If you are in an open net operating loss or an open non-taxable position, you can actually go back further than the prior 3 years, claim a credit, and carry it forward on a carry forward schedule. And the reason for that is because of the fact that the credit carries forward up to 20 years. So there are certain scenarios where you can go back even further than the prior 3 years. The credit itself is designed with what's known as a base hurdle that your credit year's expenses are measured against, and then you get a percentage of the excess. There's a few different ways of calculating the credit. There's different ways of calculating the base, but the bottom line ends up being to where your credit, your actual net dollar for dollar credit that you can use to offset tax for federal purposes, ends up being anywhere between 6 to 8% of your total qualified costs. And we'll talk here in a little bit about what those qualified costs can be. But again, it could be a little bit less, it could be a little bit more, but typically it falls within that range. And then there have been several legislative changes that have made it easier for small businesses and startups to monetize and claim the credit, as well as it broadened and given us guidance on different types of activities in terms of how they qualify. Most notably, I talked a little about this a few bullets up, but as part of that PATH Act, for eligible small businesses, and these are companies that are taxpayers that are defined as having $50 million or fewer in average gross receipts for the prior 3 years, they can use the R&D credit to offset AMT. Now, AMT went away for C Corps in 2018, but this still applies to flow-throughs such as S Corps or partnerships. In addition to that, for eligible startups, and these are defined as taxpayers with fewer than $5 million in gross receipts for the credit year and no more than 5 total years of gross receipts, including the credit year. So basically in their first 5 years of generating gross receipts or gross sales, they can use the R&D credit to offset payroll tax, which is the employer's Social Security FICA tax, up to $250,000 a year. So these were very lucrative and really key in helping small businesses and startups to be able to monetize the credit right away, as opposed to carrying it forward and waiting until they were taxable in order to get the benefit. Additionally, there has been different types of IRS guidance, government guidance, legislative guidance that have broadened the different types of activities that we can claim, most notably with internal use software. Software now, unless it's developed primarily for simply general administrative purposes, can qualify if you're developing software internally. And that can be for sale, lease, or license, or developed internally to help facilitate your services. So now what I want to do is talk a bit about the types of industries that claim the credit. The IRS puts this data out every year. Unfortunately, as you can see, they're a little bit behind. This is actually the latest data that they've put out for tax year 2013. And this does a great job breaking down R&D credits claimed by industry. And as you can see here, far and away, the #1 industry that claims the credit is manufacturing. They claim over 60% of all R&D credits awarded. And this is a trend we expect to see going forward till the present. And this is the trend that it has been since the R&D credit was enacted. This next slide does a great job breaking down the manufacturing industry. Kind of the takeaway here is it's not just your traditional manufacturers, your heavy equipment manufacturers, your electronics manufacturers, your job shops, et cetera, that will qualify for the credit, but any type of manufacturer can have R&D. You'll see on this list food manufacturing, paper manufacturing, plastics and rubber, beverage and tobacco, furniture, apparel, wood product, leather, etc. I've been doing this for over 15 years. I have never seen a manufacturer that does not have some R&D. Now, the magnitude of the credit and whether or not it makes sense to perform a study depends on the magnitude of their activities. But as you are a manufacturer, it's very important to at least assess whether or not this incentive makes sense for you, because chances are you do qualify. So now what I want to do is talk about the common reasons why taxpayers think that they don't qualify for the credit. And these amongst many others are reasons that I've seen over my time working with R&D tax credits. These are probably the 6 most common, but I'd love to walk through these. And a spoiler, none of these on the surface would prohibit you from claiming the credit. So the first is probably the most common. Our activities aren't innovative or groundbreaking. And the reason people think that is when people typically or traditionally think of research and development, they think of people in white lab coats, mixing chemicals, creating things that have never been done before. And it's great if you're doing that, but that's not a requirement. And we'll talk about what the requirements are here on this next slide. But there is no requirement for it to be innovative, groundbreaking, or new to the industry. In essence, it really only needs to be new to you to a certain degree. The second and third kind of go hand in hand. We don't track our time and we don't document our work. There is no set requirement for time tracking, and there is no standard documentation requirement for the credit. That being said, the burden of proof is on the taxpayer in order to substantiate the credits that they're claiming. The government did have time tracking requirements, but they were done away in the late 90s because they realized that they were prohibiting smaller and mid-sized companies that didn't have the resources to track time per the R&D credit from claiming the credit, and that wasn't its intention. We are able to use estimates from people who are either performing the R&D work or directly supervising the R&D work. We don't have an R&D department. There is no requirement to have a specific R&D department. There is no requirement to track R&D expenses through any type of accounting principle. Oftentimes what we see is those accounting principles, such as GAAP, do not fall in line with the requirements of the credit. So there are certain expenses that are tracked by GAAP that aren't tracked by the credit, or that are not included in the credit, and certain expenses that are included in the credit that typically don't get tracked by GAAP. So even if you are tracking these expenses, we still would need to do a study to make sure that we're only claiming and we're maximizing the expenses that we can claim. And the next one is another common one we see. Our customers pay for our projects. And we see this a lot in all types of industries, but most notably manufacturing, where our taxpayer will be paid by their customer, whether it's an unrelated third party or governmental entity, in order to perform development work. It may be fabricating prototypes. It may be designing products. It may be creating manufacturing processes in order to mass produce their products. Our taxpayer can still claim an R&D credit on those activities if they meet an additional two-part test. Now that test, the way that we assess that is by reviewing contracts and or terms and conditions associated with purchase orders that govern the relationship between our taxpayer and their customer or that unrelated third party or government entity. The first test is that our taxpayer has to maintain substantial rights to the research performed. Basically, that means that our taxpayer has to maintain some rights. As long as the unrelated third party or customer does not maintain exclusive rights, we pass that test. The second test is that our taxpayer has to bear the economic risk of development. And the way that that is determined is by looking at the payment provision. If you were paid a fixed fee or a lump sum for the work that you performed, where any overages that were in scope had to be paid for by you, then you have risk for that and you meet that test. If you were paid time and materials or cost plus, even if there was a cap or not to exceed, then the government states that you do not have risk. So basically you have to have some rights to the project, the work that you're doing, and you had to have been paid either fixed fee or a lump sum. And then finally, we've been running at a loss for years and plan to for many more. Again, as mentioned before, the R&D credit carries forward. So even if you're running at a loss, we can calculate the credits and carry them forward. But a few reasons as to why it's good to, or it's better to go ahead and claim and perform the study now, as opposed to waiting until later, is we see a lot of employee turnover and document retention issues. So we always want to make sure that we have the best information when we're calculating the credits. The other thing is that in the event of an IRS audit, one of the first questions they'll ask is, what was the number of days between when the actual R&D was performed and when you calculated the credits? Now, there is no number of days that would prohibit you or deny you from claiming the credit, but as that number of days gets larger, there can be more scrutiny that's applied on the credit by the IRS. So now that we've talked about some of the reasons why taxpayers don't think that they qualify incorrectly, let's talk about what the actual requirements are. So this is what's known in the industry as the four-part test. Your activity has to meet all four of these requirements in order to qualify for R&D. But as you see a few sub-bullets within each of these, they only need to meet one of those bullets. So the first test is the permitted purpose test. And what that is as a taxpayer, you have to have attempted, and I say attempted because failures are considered to be great examples of R&D, but attempted to develop or improve the functionality, performance, reliability, or quality of a business component. And all the business component is, as you can see here, is a product that you develop, design, develop, and sell. A process, such as a manufacturing process, and that can be a first article manufacturing process that you're developing, or any type of continuous improvement or holistic improvements that you make to your manufacturing process in terms of adding additional capabilities, increasing throughput, increasing automation, reducing costs or waste, reducing bottlenecks, etc. Software that's developed for sale, lease, or license, or develop or used internally to help facilitate a service, techniques, inventions, or formulas. The second requirement is that the activities or the development has to be technological in nature, meaning that it has to be based on some form of a hard science, such as engineering, physics, chemistry, or the life, biological, or computer sciences. It cannot be based on soft science, such as marketing, economics, law, or aesthetics. The third test is that is the elimination of uncertainty. And what that states is at the outset of development, you had to have had some form of uncertainty related to either one of these three: capability, method, or appropriate design. Capability means you're unsure whether you're capable of developing something. And that's fine if you have it, but it's not a requirement. That leads more along the lines of those people in white lab coats mixing chemicals, creating things that have never been done before. Method is uncertainty related to your developmental process. Again, it's great if you have it, but it's not a requirement. The third is probably the most common type of uncertainty that I've seen. I would actually say it's probably 90 to 95% of the time, it's an appropriate design uncertainty. And this is really kind of what's broadened the R&D credit. And what that basically is due to specific requirements that you've laid out, you were uncertain as to what exact and appropriate design your product or process or software needed to have at the outset of development in order to meet those requirements. If you have that, that meets this uncertainty test. And then finally, you had to have conducted a process of experimentation in order to attempt to overcome that uncertainty. And all that is evaluating one or more design alternative or going through a systematic trial and error type of a developmental process. You prototype something, you test it, you modify it, you test it, and so on and so forth, up until you've reached your requirements. So, we talked a bit about industries, but again, the key industries, and there's several industries that claim the credit, but the key industries that we see, and a lot of these are the STEM industries, are manufacturing, by far number one, software and technology, engineering, and life sciences. So now what I want to do is quickly talk about the costs that qualify. There's three types of costs we can take towards the credit. The first is employee wages, and these are going to be any W-2 Box 1 wages or taxable wages for employees that are doing any of the development work or directly supervising or supporting that. Now, when we talk about development work, we're talking about people that are coming up with technical design requirements, coming up with technical design specifications or specs, prototyping or modeling or coding, doing any of the testing, and all of the subsequent redesign and retest up until the point to where you're ready to go live with that product or that manufacturing process. Also, anyone who directly supervises or supports those individuals. Anyone who spends 80 or more % of their time on R&D, we can take 100% of their salary towards the credit. The second type of cost is going to be contract costs. Now, these are going to be any non-employees, so any outside vendors or 1099s that you use to do any of the developmental activities that I just mentioned. We can take 65% of their costs towards the credit, as long as we, again, have some rights to the research that's being performed by them. And in this scenario, we have to be paying them because we're the ones paying them. We have to be paying them either time and materials or cost plus. If we're paying them fixed fee or lump sum, then we're not able to include those costs. And then finally, supply costs. These are defined as tangible raw materials used in the R&D process and that are not either capitalized or depreciated. So any raw materials that you are using in order to fabricate prototypes, in order to run trial production runs or trial process runs, we can include those costs as long as they were not capitalized or depreciated. Even if we are ultimately selling that prototype to a client and we're being paid for it, we can still include those costs, the government states, because we were not able to capitalize or depreciate them. So now I'm going to turn it back over to Diane, who's going to talk a little bit about examples of qualifying manufacturing activities.
Thanks, Sanjeev. So folks, on the left-hand side, we have the generic terms of what is a qualifying activity. New products, prototype development, manufacturing process improvements of property, plants, and equipment to increase efficiencies, new manufacturing equipment, tooling, fixtures, and processes, new or existing products and processes to meet client standards. Those are all pretty generic. On the right-hand side, we've carved out those activities that are specific to manufacturing that meet those definitions or could meet those definitions. So think of it in terms of, your sales folks, the engineers that go out and, determine technical requirements and they bring those back to the engineering type folks in-house. to relay what the client's needs are, designing meetings, collaboration among the project managers and executives, product design, development, testing, fabrications of prototypes, manufacturing process improvements. We see a lot of this when you redo a shop floor and you're bringing in equipment or tweaking equipment to create efficiencies as well. That's a big one in manufacturing. And evaluating, third-party technology to help with an existing manufacturing process. Creation of molds and prototypes, that's also a very big one. And one that pops out, more than you think is packaging. It's package design and whether or not, longevity on the shelf. There's all types of experimentation in those processes. So I'm going to pause for a minute, let you take a look at those, see if there's any examples that pop out to you that you can use internally that are a good fit for your company. And while we do that, we're going to pause and take any questions that are out there, Brianna.
Great. Yeah. If anyone has any questions on anything you've heard so far, or this slide in particular, type them in the chat box and I'll make sure that they get read out loud and can get addressed. We'll get through as many as we can. To kind of get us started though, I have a couple of questions. Can a company include equipment as a supply cost?
Unfortunately, no, they cannot. Equipment is considered capitalized. It's something that's depreciable in nature and is capitalized. What the taxpayer can include, though, is the time that's spent implementing that equipment, testing the equipment, creating a process around or improving the process to make sure that the addition of that equipment is as efficient as possible in terms of their process, as well as any raw materials that are used in terms of testing that equipment to make sure that the process is running at whatever requirements are intended.
Great, thank you. Next question. A lot of our manufacturing is done in Mexico. Can I still get a credit?
That's a great question. So yes and no. So the thing about the R&D credit is it's a US-based credit. So the activities are what we call boots on the ground. It has to be done in the United States. So if production is in Mexico, those salaries and supplies may not qualify. But let's say the idea was formed here with a group of engineers and the prototype was built here, and you're just outsourcing the work of the production after it's become standard, then yes, all of those salaries and supplies that go into that idea and prototype building can qualify.
Great, thank you. Next question. I am contract manufacturer who gets paid by my clients. Can I qualify?
Yes, you can. Again, what we would have to do is, and again, we do see this quite a bit, what we'd have to do is take a look at the contract or the terms and conditions associated with the purchase order, and the areas that you can typically claim if you have some rights, and if you're being paid fixed fee or lump sum, are going to be the actual work that you're doing to design and produce prototypes of the product, as well as designing and creating a process for manufacturing in terms of making sure that all of those requirements are met. Those activities you can claim. One of the things that we see, actually the best fits for R&D oftentimes after we look at these contracts, are custom manufacturers, are job shops, because oftentimes they're developing one-offs. And when you're developing one-offs, every one that you're doing is a prototype. So there's a portion of everything that you are doing, if you're not mass producing and making copies, that can qualify for the credit, and those can be the wages or contract costs associated with it, as well as the supply costs that go into it. Since each is a prototype, And typically, you're not going to be capitalizing or depreciating it because it's being sold to a client. You are able to include those costs as well. So answer to that is absolutely. But again, we definitely would want to do our due diligence to make sure that there's nothing in the contract or terms and conditions of the purchase order that would prohibit us from including it.
Great, thank you. And looks like one more question for now. We haven't been profitable, in the past few years. Is there still an opportunity for my company?
Sure, there is. And again, that's where we would take a look and see if the company might meet the requirements of an eligible small business. If they're not profitable, if they are an AMT, that's an area that we can potentially use credits. We would also look at your state. Different state, and we'll talk about this here in a little bit, but there's an additional state credit in addition to the federal credit. Ohio is one of the states that has a credit, and there's different rules and regulations and requirements in terms of how you can monetize those credits. So absolutely, it's worth taking a look, even if you're not profitable, because of the fact that these credits could be something that you'd be able to monetize in other ways.
That's great news. Thank you. And it looks like that's all the questions we have for now.
Okay, great. Want to move on to the next slide, Sanjeev?
Sure.
So I wanted to add a couple other examples of recent companies that we've worked with for the research and development credit. One right there in Cleveland. It's a food manufacturer. They make smoked meats. They are experimenting with a new type of product, and the experimentation that took place around production. So we found a lot of activities. Obviously, a new type of product. They were experimenting with new types of packaging and the production line for this particular product. So there were a lot of supplies, a lot of salaries that went around that, and specifically the engineering for how they were going to produce it. The company is now going to receive $35,000 a year in a federal benefit, and as well as being able to go back 3 years retro. So food manufacturing obviously is a big user of the R&D, and sometimes just very unaware that they qualify. The second example is out of Southwest Ohio, and why this is not a true engineering or manufacturing company. They do have a lot of engineers, and I put this example in specifically because of the process. So they had been doing the R&D credit for years. It was a very cumbersome process. It was very clunky. They had a lot of downtime in order to do what we call the testimony calls for their engineers. By going and evaluating vendors and going through a different process, the activities were there. The engineers were using blueprinting and designs and redesigns to integrate, new systems. So the activities were there. By using a different process, they found that it was the ease of use was very different. The credit actually went up because of the expertise used with the vendor. And the credit increased up to $80,000 a year. So they were extremely happy. And we're going to get to a piece in this presentation today that talks about evaluating vendors. So we'll elaborate a little bit more when we get to that section.
All right. So what I wanted to do is talk a little bit more, about a typical kind of R&D tax credit project life cycle. So, different vendors will have different variations of this, but you want to make sure that this is all being included by the vendor that's performing your R&D tax credit study. So the first is going to be actual initial project scoping. Want to make sure that your qualification for whether you qualify for the credit, as well as whether or not the credit would be material for you to claim, as well as go back and amend, that it makes sense at the outset. You don't want to have to spend time on going through this process if it really doesn't make sense for you. Then moving on into the R&D study, we have contemporaneous documentation analysis and review. We have the quantitative and the qualitative analyses. Now again, this kind of makes up a lot of the R&D study, and really what this is going through and making sure that the qualified research expenses are properly identified through the testimony or any time tracking or records that your company's subject matter experts have or give, making sure that those are allocated correctly, that there are no non-qualifying types of activities that are being included, making sure when you look at your actual qualified research activities that or business components, these are the products, processes, software, etc., that there is a proper analysis being done to make sure that each meet all four of the requirements that we talked about, and then any additional requirements such as the contract requirement that we talked about for any work that you're being paid for, that all of that is being reviewed and assessed either through expert testimony or expert narration or through documentation. And with documentation, as mentioned, we don't have a set documentation requirement, but it is important to collect and organize developmental debris, if you will, that helps to show how each business component or activity meets the requirements or meets each requirement. And then it's very important that there is a clear nexus developed between the qualified research expenses, these are the wages, supplies, and contract costs, and the qualified research activities. Because that's something very critical and key that the IRS will ask for in the event of an audit. Then it's important to make sure that proper deliverables are put together. That is one of which is actually the forms or instructions for your CPA to be able to file these credits. Now, typically CPAs, again, there's some CPAs that may provide this service, but this is more of a specialized service. That's why companies such as ADP are providing it. It's a specialized tax service, and Diane will talk here or speak here about what are key things to look for within a provider. But in terms of these deliverables, making sure that those instructions are clear, as well as making sure that there is a technical report that actually puts together how these activities meet the requirements, as well as that clear nexus that I talked about between the activities and the expenses. Then a project delivery, making sure that you as a taxpayer, as well as your CPA, understand what was performed, what was done, how the credit was calculated, and what next steps would be in terms of filing. And then finally, in the event of an IRS audit, it's important to make sure that you have audit support included because of the fact that you don't want to have to pay additional to defend something that you've already paid for. But these are the common R&D tax credit life cycle steps. The next thing I wanted to talk about, I mentioned this a little bit earlier during one of the questions, is in addition to the federal credit, we have several states that offer R&D credits as well. As is the case with the federal credit, where all the work in order to qualify, all of the work has to be associated with, or all the costs, I apologize, have to be associated with work performed in the U.S. For states, all of the costs that are associated or allocated towards the state credit have to be associated with work performed in the state. And Ohio is a state offering a very good tax credit. Next thing I wanted to touch on is a recent court case that came out, and this actually did a great job kind of highlighting and defining what's necessary in order to be able to substantiate an R&D claim. So this was the Siemer Milling Company versus Commissioner. Siemer Milling is a milling company that had been claiming the credit for years. They claimed about $120,000 in credits per year between 2011 and 2012. They were pulled for audit, and the IRS denied all claims. Well, they went to appeals, and the courts reviewed 7 process improvement related business components. Unfortunately, the court agreed with the IRS in denying all 7 of those business components, primarily because it stated that they did not meet all 4 of the requirements. Now, when you look at these and you read through the case, looking at these 7 process improvement business components, I would argue just on the surface that at least 5 of them qualified. There were 2 that I'd argue against, but 5 of them, when you look through and you look through what was done and you look through the requirements, they are projects that, or business components that should have qualified. The problem was that the court stated that they did not meet the process of experimentation, or that the taxpayer did not do a good enough job proving that they met the process of experimentation test. And here is where we have to make sure that we are, either through narration or through documentation, being able to clearly distinguish between the different alternatives, design alternatives that were tested, how they were tested, what was the result, and which of those were the winners, so to speak, or making sure that we're clearly defining the process with which different designs or prototypes were tested, what modifications were made, how were they then again tested and modifications made, kind of that iterative process. It's very important that we show that. In the court case, all that was basically said over and over again was the words alternatives were tested in order to achieve the result. That's not enough. We need to go into more detail. There were some taxpayer-friendly judgments, most notably with regards to the fact that the IRS argued that business components need to fall within 1 year. The courts agreed that, again, they can fall over multiple years just because you're working on a project or a product or process development or improvement. That doesn't have to fall cleanly within a year. It can span multiple years with the same uncertainty. Also, the court denied the IRS's claim that engineers, or only engineers, can perform engineering work. This is an activities-based credit, and there is no requirement for specialized degrees in order to perform work that's technological in nature. And then finally, and most importantly, because of the fact that the taxpayer hired what was deemed a competent professional who had sufficient expertise to justify reliance in claiming and calculating the R&D credit, the court denied the IRS's claim to issue accuracy-related penalties on the taxpayer. So it's very important with regards to things such as the R&D credit that it's not something that necessarily you're calculating in-house, or that a CPA that isn't considered a competent professional with expertise is claiming that you're actually using a provider that has expertise, that has engineers on staff. And here, Diane's going to talk about what we need to look for, but it's very important that when you're looking at a provider that they are someone that has that expertise. Otherwise, there could be penalties that are assessed if there are any issues with the credit. So now I'll turn it back over to Diane.
Thanks. So yeah, the first piece of this, where we say putting together an R&D benefit and doing an R&D study is like putting together a puzzle. So there's one side of the house that is constantly looking at the activities and the documentation and supporting those out, to claim the benefit. But there's another side that's looking at the utilization. So when you choose a service provider, it's essential that you have a service provider that understands accounting, that can work closely with your CPA, and gives your CPA confidence that this benefit can move forward. Prepares the study according to the IRS audit technique, being able to identify if you can lose the opportunity due to tax filing times, whether you're an early filer, late filer, if there's 3 years retro, you can go back. When do those years start to fall off? And then obviously taking advantage of the utilization of the credit if it can be used to get as a traditional income tax credit, or if you qualify for the payroll piece, which is obviously very lucrative because it becomes a cash benefit that you can use to offset payroll withholding. So someone who understands all the nuances of the utilization side of the credit and that can work closely with your CPA is essential. And most importantly is what to look for, not just to work with your CPA, but who has the best expertise to do an R&D credit as a service provider. We have found that always find a provider that will do a free assessment to determine your eligibility and your benefit before you take any of the next steps, because I think Sanjeev pointed this out perfectly. It has to be a meaningful benefit to pursue before you go down, that lane. And so find someone who can do a free assessment up front. The second thing is, have the tax credit expertise behind you, meaning deep technical knowledge. They can maximize the benefit, perform the study, but also assist you and your CPA with applying the credits. And the third point there, this can't be emphasized enough. The expertise that goes around this, the IRS prefers vendors who use developers and engineers as a guideline, but they help maximize the credit. They can go to subordinate levels and supervisory roles and document out why these people qualify and the percentages of their times that qualify. And I would say the most important thing also that needs to be discussed is audit support. So whether you're in a perfect industry that qualifies, if you don't, referencing the case study that Sanjeev just put up on the board, if it's not documented correctly, it could raise a red flag. And if your provider does not provide full audit support to defend that benefit, it ties up you and potentially your CPA answering those questions. So always have a vendor that offers that as well. And ask if it's going to be risk-free for you and your CPA. Those are important questions to ask. Ask if the provider will refund fees if there is ever a clawback or the IRS, does a disallowance on a percentage of your credit or benefit. Will your vendor refund the fees? So it's an important credit. It's extremely lucrative. Find what provider works best for you. Determine what fee structure works best for you. If you like fixed fees or paying a little bit up front, or would you like a contingency fee after it's delivered? These are all important questions as part of the process for research and development. So that concludes our presentation today. Thank you all so much for joining. And certainly consider ADP as a resource if you'd like to ask some questions or pursue this. We're certainly here to give you a free assessment if you qualify.
Wonderful. Thanks again, Diane and Sanjeev. That was very informative. I'm not seeing any other questions popping up in the chat box. So I will conclude our webinar at this time. Thanks everyone for attending. And again, just as a reminder, the recording of this will be available on our YouTube channel. Thanks everyone and have a great day.